Let's go. So, welcome, guys, again to the Investment Academy. Today, we have an interesting topic, like always. We are talking about private equity. Um, Private equity is something we don't hear about every day, but it might be an interesting field to work in at a later point after your studies, if you're in finance and all the areas that are connected to it. So we're going to talk about company structures and holding companies at first because they are quite important for understanding private equity. We're going to talk about mergers and acquisitions, so meaning the sale or purchase of a company. And we're going to talk about due diligence, which is examining a company before the purchase. And we're going to talk about valuation of companies. So public versus private companies. Of course, private equity is in connection with private companies. And here I wrote down a couple of differences. So just for a basic understanding what the differences are. So private companies are often small or medium-sized companies, so-called SMEs. And they're often still held by the founder. Often there are family companies, family businesses. They have less regulatory and bureaucratic duties. And in comparison to public companies, and their shares are only tradable by acquisition via contract. So they don't have any shares that are traded on the stock market like public companies do. So all those companies that you can buy stock of, they are of course public companies because they went public. They had an IPO at some point in time, and all the companies that are not tradable are private companies. They can be big too. Not every big company needs to go public at one point, but most of them do sooner or later. So public companies are tradable on the stock market. They're open to all investors because you can just open an account and buy the stock. They're easily tradable and exchangeable. They have high disclosure duties, of course, to protect the stakeholders or shareholders in this case. They tend to be large companies, as I said, and they look to increase the profit not just for themselves but for the shareholders. So well, of course, every company basically does try to do that, but public companies have a special focus on the shareholders. And of course, they're easier to value. There are more disclosure, more information is available. We have a stock price, so we can easily value those companies. So what are holding companies? Holding companies are essentially companies that own companies, and they are the investors. So holding companies invest in and own multiple companies or stakes in companies, so they don't have to hold the or own the entire company. Investors differ in all kinds of stuff. They differ in strategies, investment focus, industries, stage of the company, what they're trying to invest in. Same with if you're into stock investing, you usually have an investment focus, right? You're trying to get into the energy sector or the automotive sector, and holding companies have that a similar investment focus. And of course, time horizon plays a role. Those investors are divided into strategic and financial investors. Financial investors are often more medium or short-term investors. They have low level of involvement. Often they just have somebody on the advisory board after they purchase the company. And strategic investors, they are often investors that are companies from the same industry. They can also be private equity institutions, private equity companies, but often, for example, a strategic investor would be if Volkswagen buys another automotive company to integrate them into their company or to just keep them on the side. They would be a strategic investor because they're not buying that company to make financial gain and to sell them after a couple of years or 5 or 10 years, but they try to hold them, and you have long-term benefits, really. They often have high involvement in the management, possibly even casting the whole board, or at least the CEO or a CFO position. But of course, the barrier between those is, yeah, like always, there's not always a clear barrier, but yeah, we tend to divide those investors into strategic and financial. what are the reasons for the sale of a company? So why would I sell my company, or why would somebody else sell his or her company to me? There are multiple reasons, and they can be very individual and personal as well. The reason is important for a potential buyer because it influences the price. Because only the seller knows the true reason why he's selling a company. And for example, if he doesn't believe in the business anymore, if he thinks that it's not gonna succeed in the next years, then of course I, as a potential buyer, would like to know that, and therefore I would probably not buy the company or pay less. A private equity firm may focus on a specific segment like insolvencies or succession. This is in regard to the investment focus that we just talked about. And here on the right side, I put down some reasons for the sale of a company. So we have changes in business environment. If the owner is not comfortable with the environment anymore, many new regulations, digitalization, everything can change the business environment in a way that the owner does not want to keep the company anymore. Then we have succession or retirement of the owner, which is pretty typical for Germany because we have a lot of family business here in Germany. We have a lot of smaller family businesses that don't find succession because their children do not want to manage the company in the next years. They want to do something else. So we have a lot of succession cases, and therefore a lot of sales of private companies. Then we have financial distress or even insolvency. So if a company is not in a good shape financially or in an operational way, then owners often try to sell the company, but of course then the price won't be as high for a healthy company as for a healthy company. And then we have capitalization. So if the owner just wants to make money, he has maybe invested at an early stage, or he has brought up the business from scratch, and then at one point he wants to do something else and he wants to take money out, then this is capitalization. So what is the acquisition process? What is actually happening when somebody sells his or her company to somebody else? So here in private equity, we first, I wrote down this process. It's not always exactly like that. It also depends on the size of the company and the private equity firm, but in general, it goes something like this. First, we have sourcing, which is finding an interesting company that matches your investment focus. Then you will have to contact the advisor because those transactions are always advised by a consulting firm, an M&A advisor, an investment bank. Those are the names of the companies that advise company sales and get paid for it. So we contact the advisor and we inform them that we have interest in the company, and then we will have to sign an NDA, meaning it's a non-disclosure agreement. So once we sign that, we can have the name of the company, the identity, because of course this information is not publicly available. You will not find on the internet, okay, company XY is for sale, because it will be anonymous, because of course it has an impact on the business. If the competitors find out, oh, okay, one of my competitors is selling, then this does have an effect on their own business as well. And then we will most likely get the information memorandum, which is a presentation about the company that the M&A advisor put together, and it includes all the relevant information about the business, what the company does, how the financials are, like all the numbers from the past years and from the current year, a protection for future revenue and earnings, and what the business environment is. So everything that you would want to know when you're interested in buying a company. Then if you're still interested, you will most likely have a lot of questions after reading this, because of course there are more specific things that will not be pointed out in the presentation. Then you will have a management presentation. So you will talk to the management of the company, or of course the current owner or owners. And usually in today's times, this happens with a video call or a telephone call, but sometimes still personal. So the potential buyer can ask the management all the questions. For example, how do you see the company in 3 years? How is this and that developing? All this stuff that gets into a little bit more detail. Then, if you're still interested, you can get a data room access. So in a data room, they will have all their company information stored, and that you need to know to evaluate a company, right? Because at the end of the day, you want to make a good valuation to know what you're willing to pay for the company. And for that, you need to get the data room access, which has all the detailed information about the company. And you will create a letter of intent. And the letter of intent is basically a paper that says, yeah, I'm willing to buy that company for probably this and that amount. It's not the final amount that the company will be sold for, but yeah, it's a first offer basically. And then you have to negotiate with the seller and organize financing. At this point, you might have gotten exclusivity, meaning that you're the only party who is negotiating with the seller. Of course, this will be better for you as you don't have any competitors buying the company, but this is not always the case. So when you agreed on the conditions, on the purchasing price, then you will have you will get the company. It's of course then the acquisition, and then you will sign the purchasing agreement and all the other paperwork that is due. This whole process is, of course, as I said, advised by the M&A advisor, for example, from an investment bank or from a small consulting firm. And this whole process takes usually multiple months. So it can take up to 12 months, for example, depending on the size and the complexity of the company, of course, because the more complex and the bigger a company is, that the more time I need to examine that company and to come up with a price that I would like to buy it for. So what are some variations in acquisitions? Some specific things that are not in every acquisition, but I wrote down a couple that you may hear when you get a little bit deeper into the industry. So private equity funds usually create SPVs, which are special purpose vehicles for the company purchase. So SPVs are companies that are just created to acquire the target company. And then we have leveraged buyout, or LBO, which is just a debt finance acquisition. In private equity, most purchases are also debt financed, meaning they are leveraged. So not all of the purchasing price is actually equity. Then we have the management buy-in or buy-out, MBI or MBO. This is the case if some managers or one manager wants to buy himself into a company. So I'm, for example, let's say I'm a CEO or CFO and I would find an interesting company and I do have some money on the side and I want to manage that company because I believe I can develop that company. Then I could try to buy myself in. And of course, the other way around too, management can be bought out by a private equity firm, for example, and new management can be put in. So reinvestment is basically keeping the current owner in the company. So after the sale, the current owner will get a smaller share, for example, 15 or 20% that he will still owe of the company. With that, you make sure that he still has interest in the company being successful and developing. Because the other way around, if you don't do a reinvestment, the owner doesn't need to care about the company anymore. So it will just be gone after you got the company. But in this case, with the reinvestment, he will still be involved and advise you, and maybe stay in the company for some time. Then we have an earn-out, which is a variable purchase price component that grows with a certain KPI like revenue, EBITDA, or the net income. So not all of the purchasing price is a fixed amount, but a part of it can be variable. For example, it's basically like a part of your salary If you're a manager somewhere or an analyst, for example, even you will not only have a base salary, but you have bonuses, and yeah, it's very comparable to that case. Then we have the due diligence. Due diligence is absolutely essential when doing mergers and acquisitions because it is the process of analyzing a company. When analyzing a company, you try to identify risk and understand the company and its environment. So you're trying to get as deep as possible, and the better the due diligence, the lower the risk for an investor, right? Because the more I know that company that I may try to buy, then the lower the risk for me that I will get a surprise after I bought it. And the final product of the due diligence will be a due diligence report. Usually this is a PowerPoint presentation with a lot of slides and a lot of detail. And it's also necessary for debt financing. So when you go to a bank and ask for a loan to be able to buy that company, because as I said, some part of the purchase price is usually debt, then they will ask for the due diligence report because of course they want to see that company as well, and they will want to take a look whether that is a good loan for them or not. So due diligence is divided into 4 parts, and we're going to go over all 4 parts briefly. So first part is commercial due diligence. Commercial due diligence is basically a market analysis, including all the factors that are soft factors. It includes the development of the market, the competitors, customers, market entry barriers, all the suppliers, of course a SWOT analysis, which you all know, and much more. All the softer factors that are included when analyzing a company. Then we have the financial due diligence. Here you're gonna analyze the major financial statements like the balance sheet, income statement, and the cash flow statement. If you were here in the first lecture, then you heard a short presentation about these 3 statements too. If they're not familiar to you, then you could either re-watch our first lecture or there are multiple sources on the internet for getting some information about the key financial statements. But you will have to analyze them, and you will have to project a company's future based on those things. You will have to say, okay, that company might develop in this and that way, sales can go up this way. And here on the right side, you see financial model in Microsoft Excel. This is an example how it can look. So you have 3 historic years, and then you will have 5 projected years. And it looks a little bit complicated, and it actually is, because the bigger your model, then the more accurate your forecasting tends to be. And this, of course, also goes for your valuation, because this is what you based your valuation on. If you have all those calculations, then you can valuate a company to be able to make up a purchase price. So going over valuation quick, there are multiple methods for valuating a company. We have the aggregate valuation method or methods, capitalized earnings method, and especially discounted cash flow method here in green on the bottom left, which is one of the most popular methods to evaluate a company. Here you're going to project future cash flows of the company and discount them, and then you will have a present value. Then you will have single value methods and comparable methods. Comparable methods also are multipliers. So you have deal multiples and trading multiples. Deal multiples are also very popular. The green ones are the most popular ones in general. And deal multiples could be, for example, multiplying the EBITDA or the revenue of a company with a certain factor. And this factor can be based on past sales of similar companies in that industry in the history. So you will get a valuation out of the basis of your EBITDA or revenue or net income, whatever it is, that you will find a multiple for. if you want to get into valuation, there are, of course, courses here at CBS that have this as a topic, but there's also a lot of information on the internet. If you are worrying about finding something, a reliable source for anything, you can, of course, always ask, and I will provide you with some reliable sources for those topics. Then we have the final two components of the due diligence, which are tax and legal due diligence. Here, of course, it gets a little bit more complex for us business people, because this is mostly done by tax advisors and lawyers, because they have to examine all the risks regarding tax laws and other laws and potential changes in regulation. For example, how does it affect my operations and my revenue if the government introduces this and that new rule? Or as you probably know, tax and legal is very complicated. It's something that experts have to do because there's a lot of money to be saved, there are a lot of things to be watched. So all those risks may affect the purchase price of the company and therefore require changes in the purchasing agreement. So those will be very individual regarding the company's circumstances. Then another topic is targeting or focusing on companies. This goes back to the investment focus that a private equity firm may have. They could focus by size of the company, by industry, the company's situation, which is pretty popular. This could be either restructuring or succession, as I mentioned before, or just a combination of multiple. To give you one example, the company that I currently work at is Deutsche Unternehmensnachfolge, and like the name already says, for our fellow Germans, we focus on profitable SMEs, so small and medium-sized companies in the DACH region, meaning Germany, Austria, and Switzerland, with upcoming succession. Often they're family business, and all industries are regarded except for financial services and real estate, because those industry they have special valuation, and they require some special expertise because they're hard to compare to other businesses. So this could be one investment focus that a private equity firm has. Then at the end, I have some examples of companies for you, just so you get an overview of who is out there in the industry. On the left side, we have private equity firms. We have some very big ones like Blackstone. They are the largest one in the world. And then we have Carlyle, Apollo, Bain Capital, CVC Equity, and Regal. Those are some very known private equity funds. If you're interested for internships or whatever, then those are some interesting employers, but of course they're also pretty hard to get into. Then on the right side, we have the companies that advise those transactions. In the top, we have the investment banks. Here we have the very famous ones, Goldman Sachs, JP Morgan, Morgan Stanley, and Lazard, which are basically all over the world and advise those company sales. And on the bottom, I have Carl Finance, which is Berlin-based, and Consus Partners, which is all over Germany. And they are more like traditional M&A advisors, not typical investment banks, but more regional, and also advise a lot of deals in private equity. Okay, so finally we can come to the discussion part and stop the recording, I guess.